Silver just did something it has not done in months. 3 days ago, it was dumping through $73. Every mainstream analyst was calling it dead. Today, $82.50. A 13% move in 48 hours. And the real story is not the price. Stay with me for the next 60 seconds, because three completely separate things just happened at the exact same time. And when these three signals converge, the market never comes back the same way it left. Welcome to the Financial Factory. I'm Ooze. 2 days ago on this channel, I covered Michael Oliver's analysis, the exact $80 breakout level that would confirm silver's next major leg. You can see that video right here. Today, that level just broke, and what's happening underneath it changes everything. Hit subscribe and the bell. This story is moving fast. I am going to walk you through three signals. Each one alone would be notable. Together, this is a structural shift. Signal 1, the technical breakout. 3 days ago, silver was crashing. Today, it is trading above $82.50, cleanly through the zone where Michael Oliver said the historic upside breakout would confirm. Not a spike, not a rejection, a clean push with rising volume in the afternoon session. The descending pattern of lower highs that defines silver since January is officially broken. When Friday's weekly close locks this in, every algorithmic system positioned for continued weakness will mechanically reverse. Every single one. The theoretical setup from 2 days ago is now visibly in motion. Signal 2. China is buying physical. While that technical move was happening, something completely separate was playing out in Shanghai overnight. The Shanghai Gold Exchange added 84,000 kilograms of physical silver this week. The Shanghai Futures Exchange added another 20,000 kilograms just today. That's 100 metric tons of physical silver flowing into Chinese strategic inventory in a single reporting cycle. This is not retail. This is sovereign-scale accumulation. And here's what makes it alarming. Shanghai silver is now trading at $89.43 per ounce. That's nearly $7 above the New York spot price. An 8% premium. Premiums like this don't exist in normal metal markets. They appear when one regional market cannot source enough physical supply at the international price. Buyers are forced to bid up locally to attract metal. For months, silver has been flowing London to New York to settle COMEX obligations. Now Shanghai is pulling at a premium that complicates that flow entirely. The world has a finite amount of accessible silver. When two major exchanges simultaneously demand physical delivery, something has to give. Quick pause. Drop a comment. If you've been tracking this with me, drop a comment right now. When did you start stacking silver, and how does today feel compared to 72 hours ago? I read every single comment. Let's see how this community is processing the move. Signal 3. Institutions are taking delivery. Now look at what was happening on the COMEX at the same time. According to today's CME delivery report, 69 silver futures contracts were stopped for May delivery on Wednesday alone. 4 major U.S. banks accounted for 50 of those deliveries. JP Morgan, 13 contracts stopped. Wells Fargo, 13. Scotia Capital, 12. BNP Paribas, 12. Not sold, not rolled forward, stopped, meaning they wanted the physical metal. Total May silver deliveries now sit at 4,998 contracts. Each contract is 5,000 ounces. That's roughly 25 million ounces demanded in this single contract month. Compare that to total registered COMEX silver inventory, which just dropped below 80 million ounces for the first time in years. May deliveries alone are demanding roughly 30% of the entire registered float. This is not normal market behavior. Macro layer, the economy. And underneath all of this sits the third dimension. The Conference Board released its leading economic index today, 97.3. That's 12 consecutive months of decline from 99.4 in April of last year. Veteran analyst Gregory Mannarino called it a full structural breakdown of the U.S. economy's forward pulse. The Conference Board itself flagged rising oil prices and supply chain pressure compressing consumer purchasing power, a stagflationary setup forming in official government data. Weak forward economy, higher energy costs, consumer pressure, debt dependency, policy paralysis. This is the exact macro environment that has historically rewarded monetary metals more than any other asset class. Silver and gold don't need a healthy economy. They need inflation central banks can't fight. They need paper currency confidence to weaken. That setup is no longer theoretical. It is showing up in official data right now. So bring it all together. 3 days ago, silver was crashing through $73. The financial media called the precious metals trade finished. Today, technical breakout confirmed above $82.50. China stacking physical at sovereign scale. 4 major banks taking COMEX delivery. And U.S. leading economic indicators showing 12 months of structural deterioration. 3 signals that were operating somewhat independently just converged in a single trading session. Convergence of independent signals at this magnitude is not a market artifact. It is the macro environment shifting into a new regime, publicly, in real time. Here's what to actually watch over the coming days. Friday weekly close. Anything above $80 confirms Michael Oliver's breakout. Anything below means the setup needs a retest. Shanghai premium. If it stays above $5 per ounce, physical scarcity signals stay elevated. If it collapses, demand pressure has eased. COMEX warehouse data. Continued drawdowns below 79 million ounces signal accelerating physical pressure on the paper market. Conference Board LEI. If the index continues below 97, macro deterioration accelerates and Fed options narrow further. Silver mining stocks. Equity moves typically lead spot moves during structural repricings. A sharp move in mining stocks often signals the next spot leg before it visibly arrives. Each of these will tell you whether today's convergence is the beginning of the next major leg or whether the market needs to consolidate first. The investors who panicked at $73 already missed the move to $82. The window between major signal convergence and broad recognition is exactly where the largest moves happen. We are inside that window right now. Now I want to hear from you directly. Are you adding into this breakout, holding what you have, or stepping back to wait for Friday's weekly close confirmation? Tell me in the comments. I read every single one. If today's breakdown gave you clarity, smash the like button. It costs you nothing, and it tells YouTube to push this analysis to more investors who need it. Subscribe to the Financial Factory and ring the bell, because when this story develops further, you will want the next video the moment it drops. See you there.